What are options? That's the first things first. So in my own words, options are something traders use to leverage and make more money by using contractual agreements called calls and puts. Calls bet on the stock to go up, puts bet on the stock to go down. Thinkorswim, which is our favorite day trading platform. Most of the big traders that you see will use this platform. Why? Because we're able to move large sums and sizes of money without any headaches from Robinhood, Webull, and all these other free trading platforms. All right, that can give you a few headaches if you're trying to move big size and money. So when you first start in Thinkorswim, you're going to have all of these things at the top, right? So we're going to go to trade and we're going to go to all products, and you can type in right here any stock you want. So let's just say I want to get in Meta. All right, so what you're going to see is the expiration dates. So when you're day trading, you always want to go weekly expiration dates. And let me explain these expiration dates. Most option contracts expire on Friday, and the only time they don't is on holidays, or if you're trading the S&P 500, QQQ, stocks like SPY, the S&P, the Standard & Poor's 500, things like that. So let me show you SPY. They have different expiration dates throughout the week. So more than one. You see how they have a 5th expiration date, a 6th, a 9th. So this is the only exception to the rule of option contracts expiring on a Friday. All right. So other than that, you will be trading Friday expiration for the regular stocks. So Meta, let's go trade Meta. So Meta, we have a Friday expiration. Today is the 5th of January, so that expires tomorrow. And if I wanted to swing Meta, meaning hold overnight, instead of today, then that would be next week or this one. You always want to swing 1 week to 2 weeks to a month out, sometimes longer, depending on what you're trying to do. But let's just say we're day trading, correct? So now let's get right into it. So I decided to choose 10 strike prices, okay? So Meta, okay, so Meta's last price right here is 127, and we're live. So this is, the stock market is still open. That's why this is continuously updating. So if I want to get into calls, remember, calls will always be on the left and puts will be on the right. This is called an option chain, okay? So calls will be on the left, puts will be on the right, okay? Now, when you're choosing an option contract, you always want to be aware of the current price. So if the current price is 127.6, then I am betting on the stock to go up. So that means the nearest strike price after this would be 128, correct? And then 129 will be right after that. So this would be called at the money. So if I'm buying calls and I want to bet on the nearest strike, which would be the strike price, of course, above the current price, that would be at the money. Okay, now in the money will be a strike price that's already profitable, meaning the current price surpassed the strike price. Okay, so the strike price, so you see how this would be in the money. Why? Because 127 is now profitable. Why? Because the current price has passed the 127 strike. So if the current price reaches past 128, this will now be an in the money contract. But because it's not at 128 yet, this is now an at the money, and everything else is out of the money, OTM. So this will be ATM, at the money. This will be in the money because it's already pretty much profitable, meaning the strike price is now within the money, right? And then out of the money. These are out of the money strikes. So one thing about options is you always want to buy on the ask and sell on the bid. So just like if you were going to the grocery store and you wanted to buy a Snicker bar, and the Snicker bar was $1.25. That is Walmart's asking price. Okay, so you can't go to Walmart and say, well, all I got is $1.15. So they're going to be like, well, we asked for 125, and we're not willing to fill or fulfill your Snicker bar unless you give us that 125. So it's the same with options. You see this ask right here? In order for you to quickly get filled, meaning your contract to go through, remember, when you're buying something, someone has to sell it to you. So if someone is selling something to you, you must pay what they're asking for. So that's a quick way to remember that. So that means this right here is always multiples of 100. This is called your premium price. Now, that means this is $24, $39, $62, $95, $100.37, $191, pretty much $252, $325, $405, $490, right? So you're always multiplying it by 100, and these are called your premiums, the price you'll pay. Now, the difference between the bid and the ask is called your spread. So you see here that the bid is $138 and the ask is $142. So we have about a $3 spread here, and then we have a $1 spread here, and we have a $2 spread here. So that means if I was to buy this for $142 and I want to quickly sell, I would have to sell at the bid. So you would be selling at a $3 loss. You get what I'm saying? So you could quickly get in this, and then, you know, you could sell quickly, but remember, you want this thing to go up. So when you're buying on the ask, you're trying to get the bids to go up, because that is how you sell. You can never sell back at the ask. You can't sell used goods, right? So that is how you buy, and it's the same thing for puts. You would still buy the asking price. So if I was betting on Meta to go down, right? If I was betting on Meta to go down, then I would choose a 126, a 125, right? So I'm betting that this thing will come down, and the only way I make money is if these contracts go up or the bids go up. So meaning, if I was to literally buy this for, let's just say 101, and it went to 1.5, right? So let's just say I bought it for, you know, $100 and it went up to 1.5. Because I bought at $100, 1.0, and it went to 1.5, I have now made $50. You get what I'm saying? So I bought it at 1.0, it went to 1.5, I have now made $50. So if I buy this at this price and then the bids go up, so remember, as Meta goes up, so let's just say I was trying to buy calls and I'm betting on Meta to go up, and I buy the 129 strike, and pretty much as Meta goes up, this goes up. You get what I'm saying? So as the current price goes up, the option premiums go up with it. Okay, now there are exceptions to the rules when options do not move or they can burn premiums. Whenever you have a pretty much strike price like this, it's called theta decay. Okay, so that means that premiums will burn if it's a choppy sideways market. Okay, and that usually happens when you have an expiration date that's very close. So the further out the expiration date, the higher premiums you'll pay. So you see how, because this expires tomorrow, they're charging me a cheap premium, because, you know, it's only fair, right? But if it's expiring next week, it gets more expensive. You get what I'm saying? And it gets more expensive and more expensive the pretty much more time I have on my option contract. So be aware of that. When you're swinging, yes, you will be pretty much paying a higher premium because you're going further out. And when you're day trading, you'll be paying a lower premium because you're trying to capitalize on the day. So why would I choose so that's the reason why if I were day trading, it's January 5th, correct? But I will literally be using the January 6th because I pretty much only capitalizing on minutes to an hour of price action. You get what I mean? And puts, you're buying on the ask. So if I wanted to buy the 126 strike, I was betting on the stock to go down, I would choose something lower. You get what I'm saying? So I would go 125 because remember, you're betting on it to go down. You're not betting on it to go up. So if you're betting on it to go up, you're going to choose a higher strike price and you're going to go to the left side and buy calls. Calls bet on the stock to go up, puts bet on the stock to go down. So if I was wanted to go up, I would choose this right here. And you see right here, it'll let me buy 10 contracts, but I could buy one if I wanted to. Now remember what I said, I'm buying on the ask, so it should say $104 that I'm spending. Here's the price I'm spending, confirm, and as you can see, this is what we're paying, plus commission, of course. So they're charging 65 cents for commission. So that is how you pretty much play options and how you use them, and then all you gotta do is press send and you're good. Now, you don't have to use this route. You can use what is called active trader as well. Now, if you want to enter these way quicker for a great day trading experience, you would go here to active trader, right? And then what I like to do is I like to detach my screen once I choose active trader. I like to go right here to this little thing right here, and I like to detach my screen, and I like to minimize that screen right after that. So now I have this open, and what I'll do is I like to pretty much bring this thing upward. So this is how I set up my active trader. I'm going to get it to look like this bad boy up here with buy market, sell market, buy the ask, sell the bid. So you see how they already have it green for you. All right, so this is buy market and sell market, and buy market means to automatically get filled. So you don't have to go in and buy the ask, they're just going to buy it. And that's usually for breakouts, because you got to think, if the stock is going up, right, then the premiums are changing fast. So you might not be able to catch the limit order or the premium. You might have to buy market so you can automatically get filled. So market is for people who want to get filled and not worried about the price. Now you're still going to make money buying market. You're just not going to get, you're not going to be able to choose your price. But if the spreads are very tight, you can still buy market, because you got to think you're still going to get filled, and it's just a $3 spread on Apple. So buying market is really, nothing. So let's just say I'm on active trader. I got to go to the settings right here, and what we're going to do is we already have buy market. So what we're going to do is buy the ask. We're going to move that over, and we're going to get sell bid and add item. So that means, and then what we're going to do is we're going to move these up near the buy market and sell market, buy ask and then sell bid. You see that? And then what we could do is we can take this flatten and reverse off. Oops, let me go back. I think I did something wrong. So I gotta do that one more time. So put the buy ask and send that over. Put the sell bid and send that over. Add item over here. Now what we're going to do is we're going to take off. I'm gonna move them down, reverse and flatten. So you see that thing that says first line? So that's all that means. This is the first line. So we're going to put buy ask up there near the first line. You see that? And then we're going to put sell bid near the first line. And then you want cancel to be there somewhere. And then on the second line, you can put auto send right there. And then quantity of buttons on the second line, just to, or you can put that on the first line, depending on how you want to play it. But you see that we have cancel and we have quantity of buttons on the second line when we do this drop down menu. Or some people like everything on the first line. So this is your second line, and auto send means if I say I want to buy, and this is how you also pick option contracts. You go here and we can do the same thing, the same stock, Meta, and same strikes. So now now it's automatically already on the asking price. So if I want to buy calls, I can quickly go here and then I can choose 10 contracts, or I can type it in myself, 5 contracts. And now I'm in the 128 calls January 6th, and I can get in quickly, and I can buy market, and it'll auto send it. Now if you check this, what they'll do is they'll ask for permission first, so you can review it. So if you have auto send off, you get to review what you're spending first. So that's good for people who want to practice good risk management, is to do this auto send, to take auto send off and review everything you're buying first. So I'm buying this for this amount. So this way you check how much you're spending first. So what I like to do is, whenever I'm trading, I like to have multiple screens up. So I'll have this one and I'll detach it. So once you make one, you only have to make one and they all can be detached. So now I can have Meta here, and then I can have Apple here. And then I can say, I want to do Apple 124 puts. So puts are still on the right, calls are on the left. So I can say I want these up here. I got 10 contracts. So basically, you'll be watching the market ready to enter active trader right here. So this is how you exit and enter quickly in the stock market.